Hello and welcome back. I want to talk through adjusting entries for a minute. So, at the end of an accounting period, there can be some expenses that a company has used but they haven't yet paid it. And any of these expenses that are incurred or used but not yet paid are a liability to the company at the end of the accounting period. This can be anything like salaries, interest, or taxes. Um, and these can be considered accrued expenses. So to kind of show you what I mean, look at this illustrated example here where we have ABC Company with a 5-day work week. The last week of 2020 is shown below. Employee salaries expense for the 5-day week is $5,000. Now, if you look at the timeline here, we have Monday through Friday on a 5-day timeline. We see that anything on the left side of this blue line is 2020. Anything on the right side is 2021. Therefore, December 31st falls on a Thursday. And then Friday starts the new year. So December 31st, Thursday night, is the end of the accounting period for the company. As such, they have these expenses for their employees for Monday through Thursday, which relate to 2020. So the company accrues these expenses. They record these expenses on their books of accounting as a liability. The company will record a proportionate amount of $5,000 for the 4 days. So if $5,000 equals 5 weeks, then I want to know how much, or $5,000 is for 5 days, and I want to know how much is per 1 day. So I'm taking $5,000 for the week divided by 5 days, gives me $1,000, and then I'm multiplying that by 4 days, Monday, Tuesday, Wednesday, Thursday, in order to get my 2020 amount. So my amount that will be a salaries expense for 2020 will be $4,000. Now, because the company isn't paying until the end of the week, so Friday is when the checks will go out, there is a recording of an expense but no cash tied to it. These accrued expenses, the money side will be coming from a liability account called salaries payable. Anytime you see the word payable, know that it is a liability to the company. So on Thursday, December 31st, 2020, ABC Company will record a salaries expense of $4,000, and it'll also show up as a salaries payable liability. Now, to put a little bit more perspective on this, let's look at example 4 here. We have Seymour Services experiencing the following events during its first year of operations. Event 1, Seymour performed services on account in the amount of $88,000. So first things first, performing services on account. Anytime you see the word on account, remember that is either accounts payable or accounts receivable, depending on whether the company expects to pay or receive money in the future. In this specific example, the company has performed services on account, meaning they've done their part, but now they're expecting to receive payment in the future. So the accounts that are affected by number 1, performed services. So we know that is service revenue. We know that revenue has a positive effect on retained earnings. So we have a positive 88,000 under retained earnings. Next, because the services are performed on account and the company expects to receive money in the future, the account that will also show an effect in is accounts receivable. That is an asset account. and that account is going up. We are expecting to receive $88,000 in the future. So once we figured out the balance sheet accounting equation is in balance, we can move to the income statement. We have $88,000 of revenue, and revenue has a positive impact on net income. And lastly, our statement of cash flows. There was no cash received or paid out, so cash flows are not affected. Number 2, Seymour Services collected $35,000 cash of the balance of accounts receivable. Seymour is collecting cash, so the cash account is increasing by $35,000. Now this cash is collected from the balance of accounts receivable. Therefore, we're going to decrease the accounts receivable account by the amount of cash collected. We no longer expect to receive this $35,000 because now we've collected it. All right, we have a positive and a negative on the asset side of the balance sheet accounting equation. We are balanced on our accounting equation, so we can move to the income statement. Do we record $35,000 cash receipt on the income statement? We do not. We've already shown the revenue in number 1, that $88,000 is revenue, so we do not double count revenue. We would, however, show the $35,000 as an inflow on the statement of cash flows. And this amount of $35,000 was collected from customers, from the customers of Seymour Services. As such, it is an operating activity. Moving on to number 3, Seymour Services recorded $49,000 of accrued salaries at the end of the fiscal year. Here are those accrued salaries. So maybe the fiscal year falls in between Monday through Friday, not on a Friday. The company has to record the number of salaries expense for the accounting period before the books of accounting close at the end of the year. So accrued salaries are going to first show up as a salaries expense. We know that expenses affect which account on the balance sheet? Retained earnings. Expenses have a negative impact on retained earnings, so I'll show a negative $49,000 there. Okay, because I'm accruing these salaries, or Seymour Services is accruing these salaries, they're not actually paying cash for them today. So we just learned that the account that's used instead of cash is a liability, and it is salaries payable. And that payable amount is going up because we are going to be liable to pay this amount in the future. Now, does this $49,000 show on the income statement? It does. It is an expense. So our expenses are increased by $49,000, and then expenses have a negative impact on the income. And lastly, on the statement of cash flows, was there cash in or cash out? There was not, so there is no effect on the statement of cash flows. So let's get our totals across and see if we're in balance. So on the asset side of the balance sheet, we have $35,000 in cash and $53,000 in accounts receivable. So we have $88,000 of assets. On the liabilities and stockholders' equity side, we have $49,000 in salaries payable and $39,000 in retained earnings or stockholders' equity. And that is $88,000, so our balance sheet is in balance. Next, we have revenue of $8,000 minus $49,000 of expenses. Gives us net income of $39,000. That is a correct equation, so we are good. And then currently our cash Net change on the statement of cash flows is $35,000. And we can check that back to the cash account on the balance sheet, which is also $35,000. We are correct. We match. So we can move on to the next question.